Bismillah ar-Rahman ar-Rahim. Alhamdulillah Rabbil Alameen. Salatu wassalamu ala Nabiyil Kareem. Assalamu alaikum wa rahmatullahi wa barakatuh. Jazakallah khair for attending today. So this is just a sort of a bonus lesson on the last one we did on equities, which I've kind of given a few examples for everyone's understanding. So I'm going to go through those examples today and some more empirical like case studies as well. So just to recap from the last session, we had some sort of analysis showed on like the biggest companies in the world. Showed like the total market capitalization was about 8 trillion of some of the top 3-4 biggest companies in the world, and you can see the divide between the rich and the poor in terms of the world wealth. The difference between GDP per capita from the richest countries in the world and the poorest countries in the world is a factor of 100. So like the richest countries in the world have 100 times, each person in the country has 100 times more wealth than as compared to the poorest countries in the world. The key aspects of companies' annual report. So we looked at, for example, if somebody's interested in working for a company or investing in a particular company, look at the annual report of the company. If it's publicly listed, the annual report will be made available, and it's a legal requirement in most developed countries. So that the key things to look out for is revenue by segment, the balance sheet, which will show you how much equity they have and how much liabilities they have, so how much loans that they have, the EBITDA, which is the earnings between interest, taxes, depreciation, amortization, and the bond issuance. If they're issuing bonds, then you know that they're basically collecting interest, right? So that's the one thing, because it's a fixed income return loan that the companies offer, which we discussed in one of the previous lessons. We discussed about equity fund indices like FTSE 100, the DAX, the Dow Jones Global 50. There's thousands of like indices that are there, thousands, and these indices are basically they're used. You can use those indices to see how a particular sector is performing, like how, if you're interested in maybe working in a sector, if you're looking at career in that sector, you can look at how it's performing. If you're interested in a particular company, investing in that company and stuff like that, you can look at how it's performing based on the indice, because the indice is basically composite of selected companies and their performance averaged out. So you can see how all those companies together, based on the weighting of an equal weighting, are performing. Equity fund fact sheets. So so equity funds, these are the funds that are there in the market today on the equity asset class. They have fact sheets as well. It's just like a company's annual report. They have fact sheets, and those fact sheets will tell you what the fund is composed of, its strategy, and all that kind of stuff. So, any questions on that? No. Okay, next slide. These are some examples of standard deviation. We went through like standard deviation, how it's used in certain specific calculations, but it's used a lot in like company IPOs. We discussed like the Black-Scholes model last week and stuff, but I just wanted to give an example because I think that was requested from some of the people last time. So for example, this example one, you have a person who has a fixed salary of £600 a month, right? The average basket of goods is given there, so like 50, 60. So it's varying, right, based on market prices and stuff. The increment in standard deviation per month is given in the other column. So like what the standard deviation is between previous month to the next month, the cost as a percentage of the salary, and then the overall standard deviation is 10.97, and the overall standard deviation as a percentage of the average basket of goods is 18%. So this is a good example to look at, right? So first of all, like, yeah, okay, so it's a fixed salary, right? The higher the standard deviation in cost requires a higher propensity to save and a lower propensity to spend. Okay, so the more higher the standard deviation is in the costs, right? So what I mean by propensity to save is how much you need to save. Like, what's your, like, if you have a choice, or like if you look at your savings and everything that you have in portions, like, okay, all the money that you have, like the £600 that you have, if you look at it you break it down in your mind, say, this is, some of it I've got to save, some of it I've got to invest, some of it I need to keep it as emergency funds, some of it I need for my costs, right? If the standard deviation so you look at the standard deviation of all those factors, if your cost, the volatility, standard deviation is like volatility, right? Is how much the figure is moving outside of the mean, right? So if you have the average, is how much is the volatility across the mean, across a period of time. That's what it is. So if it's quite volatile, then you need to take your thinking towards saving more. So that's the propensity to save, and you need to reduce your spending. So that's one of the factors. Yeah. Does that make sense? Any question?
So the volatility there is because it's less predictable, and therefore you want to make sure that you can afford things going forward. Yeah.
So the cause of the volatility, it may not necessarily be known, but obviously you can work out the cause based on, look at what's happening on the market. So a macro level, look at the micro level, what's happening in your thing. Because this is average basket of goods. So this is really, we're talking about essential items. Yeah. And then, because of the higher the volatile something is, the less predictable it is behavior. That's a general, assumption that people make, right? Like if you have somebody that's like gets very angry, you don't know, they could one day just punch you in the face or something, something like that. So it's the same thing with these things. How highly volatile, less predictable. So therefore, you take a less risk averse. More risk averse approach. Yeah. Okay. So higher standard deviation cost means less ability to react to unexpected costs. So the thing is also, what you have to look at is everyone has unexpected costs. Yeah. Like, for example, God forbid somebody gets ill, you need some medical treatment. There's you lose your job, so your savings, your income goes to zero. There's other things happening. You get demoted, or like these kind of things. So, and these unexpected costs come up, right? So therefore, if your costs, if your known costs or your like mandatory costs are very volatile, then you need to basically save more, because you're likely to face an unexpected cost, and if you don't have the money to cover that cost, then you pay the consequences of that. So that's how like investment managers look at these things. So there's no harm in using the skills that the investment managers have and applying them to your savings, right? There's no harm in that. This is okay. So that's just what I'm trying to say in terms of the mindset, right? So this is a very simple example, but you can have this graph. Everybody can make this graph, like yourself at the table. You can make it yourself, because your own basket of goods, right? What is your water, milk, all the things that are essential to you, petrol, if you have a car, all these things are your basket of goods, right? And what's the average cost that you're facing a month? Your income, your salary, then, and like how it's changing year to year, right? And that's it. So you can track it like that.
But you only really get the overall standard deviation at the end of the year. So how do you make those decisions?
Well, the thing is, what you can do is that you can look at it. So that's why you have indices, right? Indices are quite useful for that. So you can get like, for example, look at inflation, right? Because that's essentially the average cost of the basket of goods, right? So if you look at inflation and like look at the CPI index, RPI index, and then look at maybe customizing that index to make it more closer to yours. So that index can basically because you don't have the data, right? That's what you're saying. You don't have the data available. So if you don't have the data available because you're waiting, because you just started it, you're waiting till the end of the year. So you can use that data to predict your standard deviation towards the end of the year. But then when it does happen, then you see how closely it aligns. It may not be exact, but it's going to be like pretty much very similar. And you can use historical indices like that. Yeah. And then once the thing is, like, once you've collated your data, right, as in, like, let's say you do this for like 1 year, 2 years, 3 years, then you become really good at it. Like that's how it usually works. You get the experience, because most like investment managers, when they look at investment for like their clients, personal clients, they generally would have, like, they first of all, they model it. They model it based on clients that have similar kind of risk profiles, similar amount of investable assets. They look at it like that, and then they will formulate a plan. But once they've collated the data, then they know, like, so they get better as time goes on, like 2 years, 3 years. So like that's the main thing. And this is all indicators. It's not like a definitive thing. It's an indicator to tell you what to do, because the thing is, what I'm trying to understand. What I'm trying to like say is, don't base these kind of decisions on emotions or like how you're feeling, right? Because it's not going to be right. Just base it on like the maths, and it'll be much better in that sense. Yeah. Okay. The second example there, just on the second slide. So slide number 4 kind of gives just a view of a salary that's variable, right? So it's changing, and now instead of a basket of goods, what I've given is like just all your expenses. So you just add up all the expenses, right? Because you need 2 views. You need a view of essentials, that's a basket of goods, and you need a view of all expenses, right? So then you know, like, non-essential expenses, you know where to cut, where to not cut, like, you know, that every month. So the increment, the month-to-month increment is given. The percentage is given below as well, and standard deviation is given as well, 26% there. So so I may say, like, total average cost as a percentage of salary should ideally not exceed 10 to 15% threshold to maintain good saving investment levels. I mean, this is general standard, yeah, in terms of like being financially stable and secure and stuff. So yeah, I mean, yeah, 10 to 15%. So you have to look at your total average cost, what your expenses are. Yeah, and I mean, you know, there's people that have like 70-80% of their income is made up of costs. That shows living way outside of the means. Yeah. I think also, like, inshallah, it won't apply to anyone here, but there's a lot of people that live on credit, right? There's a lot of people that are you know, taking out loans or you know, using the credit cards to purchase things that's not their money. That also factors into this as well, right? So because I've given this example without assuming that, but that's future liability that you have, which makes the percentage will go down even more, because if you have that, and that's what people don't understand, you know. It's like, yeah, let me get that nice car, let me get that, you know, nice appliances at home and stuff, but you know, you don't understand future liabilities. Very dangerous, especially with a well, obviously forget the interest element to it, but like the other elements to it is also like you know, the salary and income is not guaranteed, and if it's variable, if you have variable income, that's very dangerous to be taken out. You know, loans, even if it's a halal loan, it's still dangerous. Yeah.
So is this something that lenders will tend to look at when it comes to your income?
Yeah, so lenders generally want you to default. Yeah, they want you to default. They want you to, be in debt, maybe because they won't let you default. Mostly, they will give you another loan. They say, okay, I'll give you like a bridge loan or something. So like, you can't pay your initial loan, they give you another loan. So they just want you to be in debt like forever. So they look at these kind of things. Yeah, so variable But then they balance it out with like, but if they have too many people like that, then it's not a good situation. So they look at it in comparison to their profile of clients that they have, right? So they may have if they have a lot of people that are like very, you know, good credit, good security and stuff, then they'll give the loan. I mean, the thing is like what this is a little bit controversial, but what people don't understand is like credit score, right? Credit scoring. Everybody can have credit scoring. Credit scoring. They say that credit scoring is generally an assessment of someone's credit ability to repay their loan, right? But do they issue loans based on credit scoring? Not really. Some companies do. For example, if you're buying, when I say when you're buying, I just mean like, you know, theoretically, if you're buying a let's say, I don't know, an expensive watch, for example, yeah, on a 0% interest loan, right, facility, because there's companies that offer that, yeah, they will make sure, because there's no incentive for them other than selling it, right, selling the item. They're not getting any money from the interest, so they will look at your credit score and make sure your credit score is good, right? Because then you want to pay back. They want you to pay it back. But if you're a bank and that can earn interest, then they look at you and they look at everyone else that they've got on their books, and then they will come up, the formulas will come up with an assessment, you know, based on what they need, and they'll look at how much profit they made this month as well. They'll look at all those factors, and then it will come up with that. So yeah, that's the thing. But I mean, as you can see here, right, in this example, right, the expenses, you know, like, the standard deviation in the expenses 54%, and the standard deviation of salary is 26%. So it's very, you know, this example shows there's a lot of volatility more volatility in the expenses as per the salary. So that's actually not bad, right? It's not bad, because if your salary is less volatile than expenses, then it's okay. But if the expenses as a percentage of your salary is exceeding, like I'm saying, exceeding 15-20%, then you're in danger. Yeah. So that's the thing. So the way to do this practically, because not everybody has time, right? Well, we do have time, but you know, the perception of time has changed these days with, you know, people constantly using the phones and all that kind of stuff. But if you don't have time, if you perceive that you don't have much time, the way to do this is to set thresholds, right? Set thresholds and have calculators running on Excel or whatever, simple calculators running, and you know, you can spend like, you know, 1 hour a week or something, even 30 minutes a week, just inputting the data, and the threshold will tell you, the formulas are running with the thresholds, and thresholds will tell you what's happening, and that's the best way to do it, you know, but it's just very few people do it. But like the richest people in the world, they have investment advisors doing this kind of stuff for them, full time, like all the time. They're like telling them, do this. Yeah. Hope that makes sense. All right, next slide.
The difference between savings and investments.
Did I?
Example 2. What's the difference between?
Oh yeah, sorry. Yeah, difference between sorry, I skipped that bit. So yeah, so the difference between savings and investment is like, so with savings, this is the theory. This is the theory. Yeah. So like savings are something that it's a mindset. It's a mindset. What you consider a saving has to be something that you do not need. You don't need access to it. Like, you have to think of it like you do not need access to it ever. Like you never need access to it. An investment. So therefore, there's no risk tolerance when it comes to savings. I mean, that's the best way to look at it, right? You know, people generally, if they've made a mess up, right, of their finances in a month, they're gonna go to the savings. Yeah, got that pot there. But that's not the way to look at it. Yeah, you have to look at your savings as, I can't touch it, even though inshallah you will use it, right? You will use it for something. Then that's up to you what you want to use it for. that's the mentality you got to have as smart like individual from looking at from investment best practices. Investment is something that you can take a risk on. That's it. Like that's a pot of money that you can lose it. Like you're willing to lose it. Right now, how much of it are willing to lose? That depends on you. So that's not prescriptive. It's subjective, right? Depends on person to person. Yeah, it's not objective, because some people have very high risk tolerance. Some people have low risk tolerance. So that's what depends on you. But that's how you need to look at it. You need to categorize your income. As soon as you receive your income, you have to look at it. You have to say this much money is investment. This much money is savings. This much money is expenses. Like that. That's how I would. And then expenses, break it down into essentials and non-essentials. And that if you look at it like that, pie chart like that, then you are you're doing well. Yeah. Does that make sense? Yeah. All right. Yeah, no, thanks for that. Slide number 5. So this is third example. There's a third example. I showed on the graph in the previous lesson, which was around the looking at the cost of two items from two different. The cost of the same item from two different locations, right? So if you have you have this is independent of salary, so it doesn't matter if you're variable or earning a variable or a fixed salary or whatever it is. So if you think like item 1 it has a standard deviation of 13.4, and item 2 has item 1 from location 2 has a standard deviation of 11.87, then what does that tell me, right? So for example, is it better to buy, as a question for the thing, is it better to buy from location 2 or location 1 overall over the year? Was it better to purchase from location 2 or location 1?
2.
Why?
It is low.
But it cost me more in total.
The percentage is lower than location 1.
Yeah. Okay. No. So it is location 2. The standard deviation is lower, so it's less volatile. Yeah. But it cost me more, right? £14 more, whatever. Like it's more. But that you didn't know that until afterwards, right? But like so you look at the volatility of how much the price is changing, where to buy your stuff from. The less volatile it is, that's where you buy it from. Yeah. Doesn't matter if it comes up to be more, because maybe next year it's going to be less, but you don't know that. But the more volatile something is, the more likely. I'm just giving this example to sort of add a bit of confusion. But if you look at in reality, the more volatile something is more likelihood that its cumulative cost is more. Yeah. But it's very rare that it's more volatile. It's going to be like less. It's going to be less expensive.
Yeah. Is this because of cash flow? You want to try and make sure that your cash flow is more predictable.
Yeah, yeah. So your cash flow should be consistent. Yeah, like you should be consistent. Again, if you're looking at it like this whole pie chart I described, this is to do with the expenses. So like your expenses, the fluctuation of your expenses should not vary more. And you should set a threshold. How much it's gonna vary. That shows then that you have more access to cash month to month. You have more access to your cash and that's it. So for example, I give you a real life example here. There's people that do like Airbnb, right? They rent out their property. Yeah. With COVID, right? When it happened, firstly, there was there's a massive hit in that market, because people weren't able to travel outside of the countries, and it was lockdowns and all that kind of stuff. There's a massive hit, right? So but then as soon as the lockdowns opened, as soon as the thing happened, there was like massive volatility in that thing because they people because the demand went up like that, so people were charging like 3 times 4 times more that they would normally be able to charge, right? So that expense went up, but the thing is the propensity to consume was high, so people didn't care about that extra cost because they were like desperate. They were like, I need to get out, I need to do this thing and have my holiday and enjoy myself. So the propensity to consume was higher than the propensity to save. But that's an emotional reaction, rather than their incomes didn't change, didn't become richer. So so that's an example of an emotional market reaction to an event that's happening, rather than a more like calculated thing. And the thing is that we're creatures of emotions, so mostly if you want to stand out from the crowd, you're going to try to act less on emotions than on like the actual numbers say. So that's that one. So I think do you have a question on that? Do you have a question? No. Yeah, so I think empirically speaking, what you have to do is to collect the data. Is you can use your bank statements, right, and see where you're buying like the essential items from, right? Like as in like shops, right, convenience stores or whatever, and then look at the volatility of that over time, and that way you'll be able to see where it's better to buy. Maybe you can compare it with your friends, or like your I'm sure this data is not it's not confidential. I mean, it should be alright to share that. You can maybe check with your family and stuff like that, and then you can get a comparative analysis, because it benefits both people, right? It's not just they can benefit from your data, that you benefit from their data. We're supposed to be one community. Anyway. Now, so that's that. Those are the standard deviation examples. Going to the next slide number 6. So somebody asked last lesson about Sharia compliant funds. Okay, so it was the other brother. It's not here today. Yeah, I forgot his name. Anyway, but so. Right, so I mean, I'm going to leave names of companies out and stuff here, but like you can see, there's an example there mentioned. So for example, let's look at this, right? Number one, right? So they are screening. So there's a fund, right? This is first of all, let's just look at it. It's it's a FTSE USA Sharia ETF. Yeah, ETF is exchange traded fund. So exchange traded fund means like it's a composite of stock, but the fund is traded on exchange, right? So all of the stock that it invests in combined together is put on an exchange, and it's traded like that. So these are new structures that recently came about, right? They're called exchange traded funds. So you're trading people are buying and selling the fund very quickly, yeah. So that's why it's called exchange traded, because there's a difference between exchange traded and OTC, right? OTC means over the counter. Over the counter is something that's customized, right? It's very bespoke. It's customized according to how somebody wants it to be. These things are not customized. They're set, like as in terms of like the stock that they invest in and the percentages of the constituents, the weighting of the constituents is set, and then they put on the stock market, people trade it, and then it can go either way, right? So that's
securitization.
Yeah. But but the thing is, it's just the way they behave is very different from a normal mutual fund. It's very different because it's like you're trading like 10 or 15 or 20 stock in one go, basically, yeah. So that's it. So they basically, if you look at the index overview, they've got an index. They're following the FTSE USA. So all the companies that are based in that are on the FTSE, which is the London Stock Exchange, but are US domicile. Yeah. So the trading on London Stock Exchange, US domicile, right? Business screening activities. So here's where like the Sharia kind of things come into play. So they're looking at companies that don't have excess debt, don't have alcohol. They don't invest in alcohol. They don't invest in firearms. They don't have impure food stock. So they're not trading in pork products, right? Usurious institutions. So that is interest-bearing organizations, adult entertainment, gambling, tobacco. So they're basically making sure none of these companies are involved in these businesses. Yeah, so that's good, right? I can't think of anything else really that would exclude. Yeah, I think that's not bad. Okay. Now, number 2, it shows the top 10 constituents, right? Apple, Tesla, Johnson & Johnson, Procter & Gamble, Adobe, all that, and it shows the percentage weighting. So this fund is investing in all these companies, right? Right. So which companies out there, like question mark, for, like, do you think there's a question mark around those? Just from your, like, I mean, it's a question for everyone.
Question mark in what sense?
From an Islamic perspective, like based on principles. Sorry, huh?
And gamble see. Protector and gamble see. The third one.
Oh, the third one. No, third one. Oh, fourth one. No, fourth one is I wouldn't say is okay. I because Procter and Gamble, they produce like mainly cosmetic stuff, cosmetics, and they produce some food as well.
Gamble's just a name.
It's just a name. It's a name. Yeah. No, I would put question mark on Johnson & Johnson, Pfizer, and Tesla. Just because of like the different reasons. So, like, for example, Tesla, some of the technology that they invest in, yeah, there's question marks around that from then Pfizer as well, in terms of the testing approach that they use. Is it humane? Or is there cruelty involved in terms of animals and stuff like that? So that would be question mark. Johnson & Johnson, that's because they have big investments in so they actually they don't do anything to do with arms, but they have some investments with arms manufacturers in Israel. They have massive investment in that because that's an industry that's booming. So they've invested in that. So that's a question mark. That's a question mark from a company perspective, I would say. But the fund manager has not seen any issues with these companies in this respect. Yeah, right. And the other thing that stands out is obviously the thing that I mentioned last time. It only shows you the top 10 constituents, right? It's 38.87% of the total thing. How many constituents are there? 218, right? So number 3 shows you that. But like, so that's they're saying that there's 218, right, stock, like companies that this fund is investing in. There's only like 10, 11 of them that are shown there. That's the one that they're exposing to the investor. So that's. I mean, I think somebody needs to ask that question. That's one of the questions to ask. Like, is it permissible to invest in an investment where you're only shown like about 40% of that product, right?
It would seem to fall in that category of
yeah.
You don't know.
Where you don't know, yeah. So So if somebody could ask that question to people of knowledge, that would be excellent. It's a very specific question because you can take this example. It's a very, very clear cut example, and it shows that. Does that make sense? Any questions on that?
Yeah, it makes sense. Nice example.
Yeah.
This one's a famous one.
This is a famous one. Yes. Yeah. It's a popular one. Yeah. It's popular. It's quite it's quite hot right now. Their funds are very hot right now. They're making a lot of money. I mean, if it's fine, it's fine. But I don't know. Like for me, if somebody came to me on the street, right, and they were like selling shoes or something, trainers, right? And they showed me like just the sole and said, look, do you want this trainer? I wouldn't buy it. I would be like, wait, hang on. Show me the trainer. I want to see the laces. I want to see how it looks. Let me decide what size is it. Like, is it going to fit me or not? I want to know everything about it before I'm gonna buy it. And I think everyone will be the same. But what they say is like, no, I don't want you. I don't want to tell you that because you might make the same trainer and start selling it. So that's the thing. So that's what they're doing in this thing, right? They're just saying, look, we don't want you to replicate, so we can't tell you the whole thing.
It's like someone sells you a box and it's got some stuff in it.
Yeah. There's some stuff in it. You can look at it.
It.
They'll show you a little bit and then close it back up. Yeah. But like, okay, so the last time we looked at example of a non-Sharia fund, right? I don't see, there's not that much difference, right? There's not that much difference other than the business screening activity. But the business screening activity, remember, like the only thing to note, and I'm not like, against any of these people or whatever. I'm just saying it like as it is, right? I'm just calling a spade a spade. Yeah, I'm just telling you what you see. I'm just breaking it down. Yeah, like for example, business screening activity. Now the second question that could be asked, right, to people of knowledge is that the business screening activity. Do we only look at their own specific business screening activity, right? So for example, this the companies here, right? Salesforce, for example, do we only look at or Johnson & Johnson? I said, do we only look at their specific activity, what they're doing, or do we look at what they invest in? It's like second tier, right? Because that company could produce, like for example, Johnson & Johnson, they're producing pharmaceutical products like baby oil and cream and all that kind of stuff, which is nothing wrong with that, but then they're investing in radar technology and other like things that can be weaponized. Then what do we do about that? Like, does that but that information is clear. You can see it on their own, like if you look at their annual report, they will tell you that the companies that they're investing in. So how many layers do we need to look into? So that's a good question. All right.
So a lot of Sharia compliant, air quotes, not really.
Yeah, I mean, it's based on principles. Yeah, it's very very questionable. Okay, so it gets a bit more controversial now. Number 7. This is like generally, I've simplified this text. Yeah, there's more than this, but this is the general criteria used in the UK, right? To identify stocks that are considered, according to them, Sharia compliant, right? So number 1 is the cash compliance ratio. So what they do is they work out like cash, how much cash they have, plus interest-bearing securities. So interest-bearing securities meaning that they've invested that like bonds, yeah. So they've issued bonds and they're getting interest from it, yeah. The total value of that divided by the market value of the equity, right? Over a 36-month average. If it's less than 33%, it's good. Okay. So what does that mean? That market value of the equity, again, what do we say is the market capitalization, yeah. That's the price of their unsold, the total value of the unsold shares. So the total amount of shares multiplied by the price of the share. That's the thing. So if that's bearing, yeah, if they cash in that, if the divisor is showing less than 33%, then it's okay. So they're saying that basically they have the value is more than the cash that they hold. Right.
So this is the criteria they have in the UK, and they're using this to decide whether or not something is compliant.
Yeah, with halal, if it's halal or not. Yeah.
Interesting.
Yeah. So that's a very specific criteria. So like, I don't see it. There's no evidence provided for this. I don't know. Like, there's no evidence provided, nor precedence provided.
They just came up with this number out of nowhere.
Well, I mean, I don't know where they came up with it, but like when you look on the resources that are there, right, publicly available resources. I mean, like, so you're an investor, right? You should be told how I got to some conclusion about something, right? I mean, everyone's knowledge is different, but still, you should know, right? It's a basic thing.
Proofs and evidence.
Yeah, proofs and evidences. I mean, like, you know, it's obviously like it's a further lane, like it's compulsory upon everyone to know what they need to know, right? You need to know how to pray. You need to know how to conduct the 5 pillars. Obviously, with Hajj, if you have the money to do so, then you need to know. So those are the things. But so if you're going to go into an investment, you need to know like what's the criteria that's been used to determine that. Or if you want to do like taqleed or whatever, but then the scholar should still quote the evidences and say here's where I derived this based on this evidence. You can't just do taqleed on their word. You need to go back to the evidence. So there's no evidence provided. I mean, I don't know if there is. There may be, but like I need to figure out the ratios. Like where did they get the ratios from and stuff. So this is a good question to pose. It would be very, very good, if we could take this, like, the Ahl Sunnah kind of approach to it and look at these, questions. Number 2 is receivable compliance ratio. So they look at accounts receivables and market value of the equity, right? So accounts receivables is how much money you're supposed to receive, right? So like, but it's not in your account yet. It's like something I'm gonna get for sales that I've done, divided by the market value of the equity. If it's less than 49%, it's good. That's what they're saying. So I'll just give an example there below to put this into real life perspective. Let's say I buy a car for £10,000, right, from one of you guys, and I agree that the car will be in my possession on the point of sale, right? We both agree on that. But then I'll pay you 1,000 every month, and I'll clear my what I owe you in 10 months, right? So £10,000 of value, we agreed. That's fine. I get the car straight away. I go to you, and then I'll sell you the car for 12,000, right? Straight away. But so that's like it wouldn't be acceptable. That wouldn't be acceptable because that's injustice. It could cause injustice to you. It could cause injustice to you because, first of all, if something happens to me, you're going to come after me. I've not paid your the car yet. So I've got it in my. So you need 2 things, right? You need possession and you need ownership, right? One of those things is missing, right? Possession is there, but ownership is not there because the transaction is not completed. It's deferred over a period of time. You're selling what you don't own. So I'm selling it to you, and then I'm taking your money. So there's a lot of injustice in that scenario, which wouldn't be permissible. So that's what they're looking at in this receivable compliance ratio. But they're saying that if you have less than 50% of your receivables are there, right? So you've got less than 49% is actually you've got that money, right? You're okay. It's fine. So the company has collected, like, let's say 50%. The company's collected half of the money that's owed to them on a sale that they've done, right? Then the company's fine. I don't know. I have to ask. Yeah, because I don't know. I honestly, like, I mean, I don't know. I'm not that well read, but like according to my readings, I've never seen percentages and stuff like other than inheritance mentioned. So I don't know. But obviously, like, it doesn't mean it's not there. But we'd have to ask someone who's more read.
On a similar note, Amazon, for example, is famous for creating what is called, I think, negative debt capitalization cycle. Is that a similar sort of thing? Because they're selling what they don't own, essentially. Yeah. Because they will sell. Because obviously, like with Amazon model, they don't to hold an item costs money, right? Because you have to take care of it. There's a risk of breaking it. There's a transportation cost of it, all that kind of stuff. So they will sell it from a third party without potentially ever having ownership of the item. So that's it's a unjust model, but that's what it is. That makes the whole earning questionable.
It's very questionable. I mean, I would say their ratio is very low. Like in this ratio, like like maybe some things they have to have in possession by law or something, like there's a legal requirement to have it. But like I would say most like small items that they sell, because that's why they're able to sell anything and everything, like literally anything you search on Amazon you'll find it there, right? So that because they don't need to have possession of the item, they can the seller will ship here. But what if the seller breaks the agreement and says, actually I don't want it, or they run out of stock? What it's just it's like the same example as me selling the car, but then I use the other brother. He sells it on my behalf. It's like I don't have ownership. Neither does he have ownership, but he's just selling it on my behalf. But he's taking a cut as well, like taking a percentage on top. There's layers of this kind of stuff. Yeah. Anyway, third one is debt compliance ratio. So it's the debt the company has divided by the market value over a 36-month average. If it's less than 33%, then they consider good. And I mean, there's not my words that I put on there. It's a direct quote from the don't shoot the messenger. But that's what it says. It says if yes, then you're good to go and invest in that company. So that's the. I mean, this is simplified. There's more they use, but obviously there's a screening criteria. They screen for bad stuff and take that out. That's good. I do like that. That's have to be fair. That's very good. But that's the thing. Yeah. So yeah, they're like that's to say, like when I say this is the criteria, it has been set by certain scholars, right? So there are certain scholars that have set it. Now, the evidence is not really provided in publicly available sources. Information is not provided. I don't know if you can turn up to these institutions and ask them to give you that evidence that has been used. I'm talking about Islamic evidences, Quran and Sunnah, or Aqwal al-Salaf, or like some sort of precedence in the history. But but when I personally asked a few times, they've not given me that. So I don't know whether it's worth asking, but we can ask people of knowledge that are trusted and known, that we know. But this is very, very specific and accurate criteria that can be used for the question, to see. I know, like it's difficult because the onus of the burden of proof is on the claimant. Yeah, so if they're claiming that this is a ratio, their burden of proof is on them. But because this is a service to the ummah, right? We could do it like we could reverse engineer this, see if there's evidences that support this or something similar to this, because a lot of people ask these questions, right? Can I invest in this fund? Can I just had somebody asking me about can I invest in put my money in a pension fund? But I asked him what's the fund. He doesn't know. So it's definitely a service there for the ummah if these evidences were made clear. Yeah. Does that make sense? Any questions on that? Yeah. But I mean, did you guys know this criteria? Was that yeah? There you go. So
yeah, at face value, it seems totally messed up.
Well, yeah. I mean, that's what I'm saying, because I don't know whether there's 33 percent.
But also, if it's interest, it's interest, right? There's no ratio.
There's no ratio. I mean, there's more to it. I mean, if you want me to read it out, I don't have it on the slide because it's too big to put on there. But I can read out some of the other stuff that they have. I mean, like they look at they look at, okay, so the company can't invest 5% up to 5% in haram things. So that's one of the criteria as well.
Another random.
But I don't know, like, I mean, I don't want to make qiyas of different things, but like I don't know where the 5% comes from. But like, because when I look at it very simply, and it might be wrong, but like if I'm looking at food, I can't consume 5% like haram food and the rest of it is alright. So I'm like, oh yeah, the threshold is low, and that's fine. But that
I eat pork only 5% of the time.
Yeah, 5% of the time, or like you weigh your food and it's like, that this has this much, like So yeah, I'm I don't want to make a chaos, but like, how does that how's that considered allowable when it comes to investing in a company? I don't know. I'm not knowledgeable enough to answer that, but it's a good one. I'm just trying to think. Yeah, I mean, there's a lot. It's pages and pages of text, but like this is the main criteria. That's the yeah. But like, so for example, so this is like companies listed. Some companies listed on a Saudi stock exchange, right? So we have Saudi automotive, like number one Saudi automotive services, Al Idris Petroleum and Transport, or whatever national, and then you have Al Qura Cement Company and all that. The Saudi stock exchange is called Tadawul. Yeah, it's called Tadawul, and it's actually the data on there is brilliant actually, because it's it's powered by like the company I mentioned last time, Refinitiv. Have very good technology and data sourcing ability. Anyway, so they have a listing of companies that they consider. Or if you go into Double, you can see they have a listing of companies they consider as Sharia compliant. Yeah, all of these companies that are listed here, they consider Sharia compliant, and they actually have a very nice table that shows you which scholar has said it that it's Sharia compliant. Yeah, and why as well. So you can go and look that up yourself. But it's I mean, somebody was asking like, are there any examples? Last time somebody asked, are there any examples of companies that are Sharia compliant? So it's very good to check out. I actually looked on there, like they actually mentioned, like from like scholars from the Lajna Daima, like there's scholars' names mentioned on there, like they've said that they've looked at a company and they've said it's fine. Yeah, very good. I mean, there was mentioned one company I saw said Sheikh Salih Fawzan has said it's fine. So there are like that. I mean, some of the names I don't know those names, but like doesn't mean that it's not, But and there's reasoning for that. But like for example, if you look at this Al Qura cement company, right? Okay, like on the face of it, like cement is fine, nothing, it's building material, there's no problems there. Looks very legit. But like, I mean, I wasn't able to print out the actual annual report. But you can download it. You can download all the annual reports from the Double. You can actually, there's one click. You just go there. You can download the Excel file. It's not the full annual report. Yeah, but it's a summarized annual report Excel file that gives you, but it gives you what you need. You don't need to see the other stuff is not interesting anyway. So like for example, with this Qura not university, Qura is university. So Qura, the cement company, I looked at the annual report, right? The only thing I could see on there was question mark, but which I'm sure you can probably ask the company about, was like they had short-term borrowings of 33,000 riyal. Yeah. So that I don't know, like that just need to check like if it's not interest bearing, they're borrowing, because it could be non-interest bearing, because there are loans I know in Saudi that are non-interest bearing, right? That government issues as well, so they could be, but it doesn't state, it doesn't tell you what that is. The second thing I saw was they had a debt, they had borrowings in sukuks, so like earnings from sukuk. Yeah. So they've issued sukuk, which is like the Islamic version of the bond, of 582,000 riyal. Right. Now we just need to check the conditions of the sukuk. Like, is it like an actual portion of the company, or are they selling some? Have they given some physical asset of the company away? Right. Because the bond, remember the difference between the bond and the sukuk, right? Was the bond is just it's an arbitrary the arbitrary loan on a fixed and it's a fixed return, right, based on the company's performance and stuff. But like a sukuk is actually based on physical asset ownership. Like I gave the example of like a car rental company. Yeah, you borrow money from people to rent you rent cars, and then from the profit made up from the cars you give it to the people, and that could fluctuate and vary. So it could be something to do with like, I don't know, tractors, machinery that they have, and like the usage of that machinery, how much output they're getting out of the machinery, and that way. So that's it. Other than that, I couldn't see anything on there that's looks questionable or stuff like that. So
fascinating. I never knew that.
yeah, so there is hope out there. Yeah, I mean, like the performance is good. It's not bad, The performance of this company is not bad, right? It's 16.64% increase over 3 months. 21.77% over 12 months. Yes, it's quite good. Yeah, so. And I'm not just using Saudi as an example. There's others like Malaysia, Indonesia are very, very good in this. There's other Muslim countries. The stock exchange is less developed, I would say. But like I'm talking about the most well-developed stock exchanges. Yeah, it's like UAE, in the Muslim world, UAE, Saudi, Indonesia, and Malaysia are the best. And you have a big pool of like companies than that. Yeah, there's a huge pool. Yeah, I actually know the person who actually designed and developed the Somalian stock exchange. That is a very good friend of mine. It was it's been there for like, I don't know, I think 6 years maybe, and it was a very good friend of mine. He actually came up with the whole concept and idea and everything. I did a lot of work for them in terms of the data validation, how to validate the data, how to get the indices information and all that. So. But there's it's good to have a stock exchange for these Muslim countries. Obviously, we mentioned Somalia as an example because it's one of the poorest countries in the world, probably the second or third poorest country in the world. There's a lot of diaspora from Somalia here in the UK. A lot of brothers attend the masjid as well, so it's good. But that's excellent that they now. And most of the companies that are listed on that stock exchange are actually private. Like it's publicly listed, but they're like. They're owned by like people that like it's like, oh yeah, that guy over there, oh yeah, the guy who lives down the street. It's like that. So it's very young in its maturity. So it's good to see that kind of stuff. So yeah, but do your research, look at the double. It's good. Not like promoting them or anything, but it's definitely. I've just broken it down for you. Go and research. Yeah, they have a nice Sharia section on there. Lastly, we didn't get to cover private equity, venture capital, so I'll quickly go over that in 5 minutes. It's not that deep, but like so private equity. So like in the next slide, private equity is like alternative investment. It's an alternative investment class, which is capital basically not listed on a public exchange, right? This is essentially private companies that sell to the public, but it's a private sale. Like it's like a deal between people that's not it's not publicized.
So that person can't then sell their share to someone else.
No. Yeah.
There's a name for that, isn't there?
The
type of asset which is not untransferable.
There is, yeah. I can't remember it now. It's probably in your book, but I don't remember now. It's not coming to me now. But there is a name for it. Yeah. I mean, even like, so you can have a fund, a private equity fund that has limited partners, and all those partners have to own 99% of the shares in the fund, and all this kind of thing. But with private equity, I mean, the good thing about private equity is that it's a model that we can implement like very easy. Like you can look at, if you know people that own businesses, that are looking to grow the business, if you have money to invest in their businesses, then the private equity model is very good in that sense. You have the venture capital, which is like the funds that pool investments. There's a venture capital funds, they pool investments who are basically looking at small companies, startup companies that are potentially worth a lot. So again, venture capital can be used. You can have people. I mean, I get approached by universities that have like people that are producing like tech stuff, like apps and stuff like that. And they'll say, look, there's a company that's they haven't formulated the company yet. They're producing. It's an idea, right? It's an app or is it some piece of tech that they're working on. We have like obviously an NDA, whatever. They'll discuss it with me, and then because I've got access to like investors and network of people that could potentially go for it. So those are like venture capital stuff. So it's an point of inception. So, but if you inject the money at that stage, the returns can be huge. So, but at that stage, it's great in a great sense because it's very virgin, right? There's no things that have happened, like they haven't invested in dodgy stuff, they haven't done any, they haven't taken out loans and all that kind of stuff. So that if you can see the venture capitalist opportunities can be very lucrative and can be quite interesting to look at. They can also flop as well, but it's a high risk return that type of thing. It depends on the threshold and stuff. But like I said, I'm trying to give ideas, alternative things, right, from from an Islamic perspective as well. So like those kind of things. So if you're aware of people that are doing these kind of things, or even brothers should be involved in like think tanks or sitting together, like you have these kind of like the companies have like hackathons and all this kind of stuff where they're producing like apps and things like that. And in the next like course when I talk about career and stuff, I'll try and give ideas and like how to develop like things like that, like new technology, business ideas, how to come up with one. Like how do people actually come up with one? It doesn't happen like the way they show it in the movies where someone's walking down the street, something happens, they go, oh, that's brilliant. Like, it's not like that. There's actually a thinking process behind this, and it's not just like brainstorming, like, okay, let's put like random like words on the page and stuff. There's a proper thinking process behind it. I'll go through it in the next thing where how you can actually come up with the concepts of an idea of a business strategy and plan and stuff like that. And then but with venture capital, it's not just like there's not just like a bunch of geeks sitting in a room and it's very secretive and they explain this idea. They actually have the business model laid out properly. So if investors come in, they know that this is how they're going to grow the business and stuff. I mean, if you watch like things like Dragon's Den and stuff like that, right, you can see like there's people that come in with no idea. There's other people that come in with real thing, and then those people, the investors, they're able to very quickly ascertain if the business is worthwhile for them or not. So that's a very good show to watch, just to see the interaction. But it's not about, people watch it for the drama, but I watch it for the financials. I look at how somebody can like value the companies and stuff, and I try to see in my mind like, would I value it similarly or what, that kind of stuff. So it's always good. And like, for example, like venture capital, also like the government sponsors it, right, as well in the UK. So if you have a company that's like eligible like for for venture capital, or you have a company that's I mean, if it fits the government's criteria, basically, right, then, and it's a long list of criteria they have, then they can inject money into your company from investors, because they, if you heard of like EIS funds and those kind of funds, have you heard of EIS funds? Yeah. So they can put your company into an EIS fund, which is basically a tax incentivized fund, because obviously dividends that are paid out from funds, right, are taxable. Yeah, the money is taxable, depending on like how much money you've earned from other earnings and stuff. If you reach the threshold, then they'll tax you lower rate, higher rate, whatever. But EIS funds are they were previously exempt, but I don't know right now if they're exempt or not. But they are there's very low rates of tax. But I'm looking at it from the other angle. I'm not saying go and invest in an EIS fund. I'm looking for another angle. Like if you're part of an EIS fund, then it's very beneficial for you because you can attract loads of investors if your company is part of ES fund. Yeah. Like, I mean, I'm giving tech as an example, but like, because most of the companies there are tech companies. Doesn't have to be a tech company, by the way. It can be any company. But like, most innovation happens in tech. That's you know.
It's the definition of tech.
Yeah, it's that's it. Like, you're not gonna come up with a like a business process in your company that's gonna revolutionize the way that business is done, right? Well, very unlikely, right? Yeah, unless I mean, if you can, then that's great. But you will have to use some sort of tech anyway to enable that. Yeah, so that's it. So like, I mean, the last slide was just saying, key considerations for equity funds. So like, investing in local privately owned business enterprises, funds focus on local private enterprises. They provide like real benefit over just like speculation and stuff like that. So like I said, I mean, if I've never seen in this country or whatever, like, as an investment manager or somebody that manages a fund that consists of like local businesses. Like, it's a fund consisting of local businesses. Like, you have like a taxi shop, a company that runs taxis, company that runs halal butchers. You have another company that runs. There's a fund composing of all of those together. Company that has a coffee shop around the road. All of that together, and then allowing people to invest in it. That would be there's a business idea right there. That's great, because you can help grow those businesses, and you can the dividends paid out to the investors. Like, it's a very good growth model. But it needs a lot of cooperation and a lot of trust as well. Those companies need to be like sign up to agreements that they're not going to do anything dodgy stuff like that. They'll have to give up some ownership of their things, but it can be done. So that's just a few examples there. So yeah.
Is venture capital similar to the Sukuk model?
It's similar to the Sukuk model, but it's more like it's like grassroots kind of thing. It's very very grassroots. It's like something that's just basically just bubbling. People are having a conversation and they're doing it, but they've got a strategy and everything. But but the thing is, like, the product may not even be there yet. It's or the system may not be there and all that. So it's similar in a Sukuk model, but like with the general Sukuk model is around like, so like I give the example of a car rental company, right? Like, I just need money. The cars exist. I can it's fine. I can buy. Cars exist. I can buy the cars. Or if I'm doing a house rental thing. Houses are there. I can rent them out. Stuff like that. Just need the ownership. Just need the money. So that's it.
Right. And what about the ownership in venture capital? Is it the firm that ends up with the ownership, or is that distributed across the portfolio investors?
It's distributed. Yeah. But generally you find a distribution in venture capital very low, because it's quite secretive, isn't it? So they will invite a private gathering of people, select people that will go to a Chatham House Rules meeting. Chatham House Rules is like basically whatever happens in the meeting stays in the meeting kind of thing. That's thing. So like, and then that will be discussed and and sale made. So it will be very very limited. Yeah. All right. Cool. Thank you very much.